All right, I made this whole bowl of a thing with some rice and some steak and this whole bowl of a thing. And I look up and I check the time. And I'm like, well, golly, it's almost Fed meeting time. So very straightforward. Drinking games up, over unders. Let's see what you guys got. Let's see who wins this. Let's see who wins this bet. Wait, it's not a real bet, right? This is all games. It's all for fun. Well, all right, welcome back, everybody. If you're watching this on YouTube, God have mercy on you. You found yourself to the right stream. Welcome back, people. Another Fed press conference. The FOMC had their meeting last week. Now we get to hear Jerome Powell justify the decisions of the Federal Reserve and the Federal Open Market Committee on why they're not raising interest rates or why they're not lowering interest rates. We have a little fun bingo game here that we're going to be playing. Every Fed meeting has very specific components that we usually don't get to hear about until the Fed meeting minutes come out, where we actually get to see the notes of the discussions that they had. Like obviously, guys, they're having a lot of discussions outside of those formal meetings to really make these decisions. If we're just going to be completely transparent here. But the press conference is going to be a chance to basically ask Jerome Powell about a few important things. Mostly, people are looking at interest rates. When are they going to come back down? There's a 50-50 chance of an interest rate cut in the May meeting, so I'm sure we're going to get asked about that. But most Fed meetings are typically standard. That's why we have this bingo game here today. Basically, got a guideline of what we're expected to hear from Jerome Powell. If he says data dependent, or he mentions the Fed's dual mandate for price stability or maximum employment, that's got to be 1 point. That's a give me, right? That's a giveaway. We know he's going to say that at least twice. Okay. Um, they might mention the Fed's blackout period. These are all like, minor things. Now, we are getting a new, what do they call it? The FOMC monetary projections or Fed's economic projections, which is basically their outlook for the year, what they're looking at in terms of the four main pillars of GDP, unemployment, inflation, and I think they're going to be just kind of giving their guidance on interest rate policy. So this one's going to be pretty important, but mostly there's a lot of political stuff going on, so I think that's going to dominate the discussion. They're going to talk about tariffs. How do Trump's tariffs impact your ability to do your job, Mr. Powell? Right? They're going to try to pin Jerome Powell versus Trump. This is how the politics kind of plays in to these meetings. They're going to ask about the political influence to lower interest rates if Trump picks up the phone and says Jerome Powell lower the interest rates, because obviously he's trying to negotiate and he needs, if Trump's negotiating with a different country and he needs favorable interest rate policies in order to do something, there may be a temptation to influence the Fed's policy. And so they're going to ask him how likely it is. Jerome Powell's obviously going to say that the Fed is an independent agency and that they're completely apolitical and independent from the political influence. That's guaranteed. So that's 3 points. And then you know this like fucking slight economic nerd news where the Atlanta Fed's GDP numbers from the GDP Now website came out a little bit lower than expected. Okay. And it seems like they're expecting a massive drop off in productivity. And so they're gonna get, Jerome Powell's gonna be asked why that is, and are they actually expecting a massive economic drop off? This means that we're going into a recession, is what the Atlanta Fed is predicting. And this came out of nowhere. And so is this a political thing where they're kind of being like worst case scenario pessimists to Trump's policies? And they're saying like if these tariffs don't work out, we're going to go into a recession and there's going to be supply chain constraints, et cetera, et cetera. Meanwhile, Wall Street and sort of other, I was want to say mainstream banking data providers, they seem to have a more either neutral or optimistic approach or optimistic outlook on how those policies are going to impact the markets. Okay. So if you guys are tuning in, we're trading NASDAQ, NAS 100, or NQ, depending on if you're trading futures or CFDs. NASDAQ's in a range. I think that there's a good chance that we break out of this range, but Until that happens, I'm assuming that we stay in the box. There's always a chance we break out, but here at Chart Addicts, we trade a very, very simple strategy where we find our range, and then even though we expect these moments here where the market's gonna dip either to the outside or to the underside of the range, my expectation is that the market will continue to consolidate until it doesn't. And the one time that it does not consolidate, it actually does break out. Good riddance. Then we can trade with the trend and trade inside. Like kind of as the market forms, it's gonna create these structures. We're gonna be able to identify those structures by matching them up with the historical data to the left. Okay. But simply put, market is in a range. We're on the top side of that range. Last I checked, it's buy low and sell. Right. And so we know exactly where we're at. Top of the range usually means sells. And we'll see if this time the market respects that same pattern. Okay. I'm looking to take the market down. Yes, you heard it right. If you guys have been on these live streams more than once or twice, you know that I never short. But whenever market's in a range and it's the easiest trade I can get in and out before anything crazy happens, I'm always going to take that bet. Okay, so I will be taking the shorts if the market does give me the opportunity. And then once the market makes it to the bottom of the range, if you guys have taken the master class, you know exactly where that entry is on the bottom side. That's the real trade that I'll be looking for. Okay, that's the real sort of like, we're going to look at the structure. So we have the shorts right here, slightly above the current highs. Okay, you guys can draw your fibs from the top to the bottom. If you've taken the master class, you know exactly which fib level we're waiting for. It'll be sitting right there. And then the longs at the bottom of the range, that is what I'm the most excited about. Okay, expecting a bit of a double bottom here, or maybe just a clean 88, scalp, and then we can jump out. Okay. Holding trades or looking to do a swing trade or looking to overstay your welcome, especially on high impact news days, that's just not a good idea. Okay. Not financial advice, but that one kind of is. That's risk management advice. All right. Shadabel, good to see you on here. What's up? If you guys leave something in the chats real quick, drop a like if you're watching this on YouTube. All right, the number one live stream right now happening that you're on. Okay, so there's a pretty short list, but hey, who's measuring, right? Who's counting? Jerome Powell steps on the podium in about 20 minutes. We have our bingo cards right here. Over under. Are all these going to get mentioned? Yes or no? Put a 1 if you guys think these are all going to get mentioned. Put a 2 if you're like, Roy, let's just take a smoke break, come back when Jerome Powell's ready to hit the stage. Look, either, hey, either one works for me. All right. I work for you guys. As I'm on your time right now. Abongale, good to see you on here. Free sauce being given out. Bryce, I just started the roasting, so before you get over,
I hop on. The first thing I see is a bingo drinking game with FOMC. I'm like, all right, we back at it, baby. We back.
He's like, wait, we're supposed to wait until the Fed meeting to start?
Yeah.
He said, I'm already. All right. Well, look, we know how they're going to go, but it's very boring. And so I'm like, okay, at least I can do a magic trick, right? Oh, look, I'm going to predict what Jerome Powell is going to say, right? And it's going to happen over under, right? But you're over here clicking your heels and whatnot in the chats being like, oh, there's a bunch of free sauce. No, I'm about to get started on the roasting. And so don't get people's hopes up. People are just getting on the stream for the first time. Miled, good to see you on here. What up, yo, David Sanchez, yo, Ray, good to see you on here, bro. We got the whole squad, man. Instant. You guys saw a Fed meeting and the name Chart Addicts pop up and you clicked, and that's why we have the most intelligent audience in the world. People know. If you want to get entertained on a Fed meeting day, you're not going to go to Yahoo Finance. Newsflash, C-SPAN's not going to help you. But you came to the right place. Okay, combination of getting free sauce and also who has a bingo drinking game. Okay, who else has that? GDP now These are certain things that I'm looking at. This Atlanta Fed released their GDP expectations, not good. Their forecasts are abysmal. And so hopefully that's going to be the first question Jerome Powell gets asked. He's going to do a quick 5 to 10 minute thing, pre-rehearsed. He was in the mirror practicing this speech, and then it's going to be the actual Q&A with the reporters. Now, I don't know if the Fed is doing the same thing that the White House is doing. The White House briefing room has now been opened up to basically non-traditional media, so podcasters and shit. And so let's see if those same podcasters are invited into the Federal Reserve briefing room. Okay. About 20 minutes. I am gonna go grab a drink or two, not this kind of bingo drinking. I'm gonna go grab some ginseng tea or something. All right. I'm gonna go keep it light today. But I'm gonna be up for like probably 2 to 5 minutes. You guys hold tight. Don't lose it. I'll play some music in the background or something. Some copyright free music. Um, let's see. Oh yeah. No change to the interest rate policy. 4.5% remains the standard. This was expected. There was a 99% chance of no changes, but Jerome Powell will be asked about the May Fed meeting where there's about a 50-50 shot of a rate cut. And so we're going to have to get some answers for that to say if that's going to be expected or if they're waiting for something to break in the economy. Because if Jerome Powell tells us, look, in May, we're probably going to, think about lowering interest rates, that's probably where our projections are headed, then no matter what happens in the economy, when they go to lower the interest rates, it's not going to seem like there's anything wrong. Because the Fed usually only steps in when there's something wrong. You see them and you're like, hold on, what are you guys not telling us? But if they tell us in advance, hey, this is going to be like, this is just another scheduled thing, then the markets don't panic, right? So regardless of what they do, the markets are going to rally. They'll be bullish. And so everything is just setting expectations and then kind of beating those expectations. This is Jerome Powell and the Fed's game is the markets don't care about what the interest rate is. What they want to know is what is it going to be and is that for sure? Is that a certainty? Because you can't really do long-term investing with volatile interest rate decisions and Fed policy decisions constantly. You have to set a precedent. You have to be able to stick to that framework for a long time. Okay. And that's what Jerome Powell's been doing. Very likely why we're seeing this rally. I mean, we kind of went through this yesterday and on Sunday. Now, the only thing is that if we break this region, if we break these highs right here, and we start to form new, like a higher floor, very good shot that the market just continues to the upside and goes up to the 20,000s and beyond. So kind of undoing a lot of this recent bearish retracement. What I think is that we have one more correction back to the bottom of the range. At least that's what I'm hoping for. This is called wishful thinking, people. This is what it looks like to wish upon a star. That not only do we get a good scalping opportunity here on the shorts, we can also go long here at the bottom of the range, if only. Okay, let's see if the market's feeling generous today. If we get a clean breakout and there's no sell trade, then it is what it is. I mean, what are we supposed to do? We'll talk about some people setting Tesla trucks on fire. People, sell the car for fuck's sake. Setting them on fire is crazy work, right? All of a sudden, Elon Musk just saved three of our astronauts from the International Space Station. They were stuck up there. They should have been stuck up there for only a couple days. He offered to help. They didn't want his help back. It was a political stunt back in the Biden administration. And these poor people have been stuck up there in the International Space Station for like 6 months. This guy goes up there and saves them. People out here setting their cars on fire. What the fuck is wrong with people? Can you guys give me one good rational reason for why you would set your Tesla truck on fire? Sell it. All right.
People working straight off emotion, brother. That's all that is.
Brother, I've been emotional.
Yeah,
been
yeah.
very
Well,
emotional.
those are grown babies is what those are.
No, bro. There's got to be a level beyond that, right? Right? Everybody's punched the front desk clerk at the 7-Eleven. Hey, we all get emotional, right? Said we've all been there, right? Just fucking assault the front desk clerk at 7-Eleven. Just, you know what I'm saying? Anger, emotion. Setting your car on fire, brother. It's a nice car too. Go sell it. Leave it on the side of the road. Don't buy one. What are they so mad about? Can somebody, Bryce, can you break down to me the zeitgeist here? Because you know I'm trying to stay as far off social media as possible. What what is the thing? If we were to play devil's advocate, what the fuck are these people mad about?
That they it's dude it's like I truly believe it just comes down to like not getting their way, and like I said, just being overly emotional. Like that's all it is. Like it's not winning what they wanted to win, so now they're going to do everything and throw a fit, just like a kid would when you don't give them what they want.
Like in terms of the election, they didn't get what they want.
Correct, and it stemmed from that.
Oh my. Okay. And
Tell me
so
I'm wrong.
so it's not about the message, it's about the messenger. Like they don't care about what is happening. As
Exactly.
long as he's doing it, it's a no-no.
100%. He could save the world, and there would still be people complaining and burning their Teslas.
Okay. See, this is why we should have never shut down the asylums.
Yeah. Yeah. Go back to
Bring
those
back
lobotomies,
Arkham.
baby.
Send them straight to Arkham. This is fucking crazy.
Bring back lobotomies 2025.
All right, well, you said that. I don't even
Yeah.
know what that is, so I'm gonna refrain. That sounds, you know what I'm saying? Sounds like what you do when you catch an animal, you put them on the wall. I don't know what I'm getting these things confused. All right. Look, um, can somebody in the YouTube section, please, what is the thing? Like, what are if you guys are chilling in these liberal huts and these, you know, what are they saying? What is everybody so mad at Elon for? Is it because he's got too much like he thinks people think that he has too much power? Because I agree. Like, look, don't get me wrong. This is all cool and fun and games. I think Elon is one of the smartest people that we have. I have a lot of confidence in him and Trump to be a steward of the ship. But if this was flipped and then the same exact roles were given to somebody else, I don't know how I'm feeling about this. And so I can understand there are some valid concerns here. But that's like a rational concern about constitutional powers and constitutionally drafted departments versus, you know, security clearances, et cetera. That's a conversation we can have. Setting the cards, please, somebody tell me why are these people so mad at Elon? Is it because he's bringing on the carbon revolution single-handedly? Maybe trying to send us to Mars and in the process creating revolutionary technologies to get us there and to sustain us there. And that technology is going to be so advanced, it's going to help all of mankind here. Maybe that's what it is. Is it PayPal? Are they still mad about PayPal? Is it the fees, Bryce? Are they mad about those fees? This guy, there's a hurricane that happens, Helene. This guy sends out Starlink like workers to go out there into the mountains of the Appalachia and just to fucking give away free internet to these people. Ukraine's happening. They're calling this guy a Putin lover. This guy sends up satellites into the sky, gives Ukraine free internet. Is that why they hate him? He didn't give Ukraine fast enough internet.
I like what you said though, that like, he is given a lot of power. If it was anyone else, it would be kind of, a little sketchy. And I can understand where some of the frustration comes from on that stuff. You said that beautifully, I think.
Yeah, except I was trolling. Bro, you know he has the highest security, you know he has the highest security clearances that anybody in the government can have. There's people in the White House that don't have the purview that Elon Musk has because of all the
Absolutely.
defense contracts. This is they like he acts like a schlep like on fucking social media because he's actually funny as shit. You know what I'm saying?
Yeah.
If you understand you know like spectrum humor. Like if you understand like the humor, you feel me? If
Yeah.
you're to the fucking to the
Yeah.
frequency, this guy's the king, bro. He's literally he's the final boss, right?
Yeah. 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 Agreed.
But at the same time, bro, aerospace like NASA just called him for help because they had their astronauts stuck up there for 6 months. It was a 2 day mission, Bryce. They've been stuck up
Yep.
there with these poor people for six fucking months, and
Yeah. No.
he got him down in a couple days. He's that good.
Yeah.
Okay. I think he can fucking handle like bringing like these giant paper warehouses online, which is really what he's doing. And then in the process being like, dude, Zimbabwean fucking salsa classes, be like, that's out. That's gotta go. All right. That's not that much power.
Yeah.
Nicaraguan bachata classes, we gotta stop, man. Iraqi Sesame Street, Bryce.
Yeah, 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 yeah. I
Bro,
know,
he's
bro.
the next Mussolini. He's basically the next Mussolini. If
Yeah,
he ends that program, he's basically fucking, he's basically Stalin at this point.
yeah, yeah, bro.
The detransitioning clinics in Nicaragua, bro, really?
Oh man.
This guy's basically Genghis Khan at this point. So we're all doomed, bro. This is like 1984. Remember in 1984 when
Yeah,
the fucking when the South Himalayan fucking
yeah.
yo, remember when that program got cut in 1984, bro? And he said, "Big Brother's watching," right? I said, "No, not the Zimbabwean." The trans mice was really funny too. It's like, bro, why? Why are you doing this with the mice? This is sick people, man. These are sick people. Leave the mice alone, man. There's no medical benefit to that research in any way, shape, or form. These people fucking up these mice, man. All right, we gotta stop this. They're trying to say that this guy is Stalin. He said, no, stop fucking with the mice. They said, oh, he's Hitler. It's madness. He's cutting out the free handouts. That's why. Chris, you just nailed it. Bryce, could that be it? Could all these people who are
100%.
grifting and grafting off the fucking government asleep at the wheel, who have been getting paid out for doing nothing but scheming, and then that money faucet just comes to a dead stop? Could those people be mad enough?
100%.
Hmm. Right. Nothing's gonna get more mad than a schemer when his handout stops coming in. They're gonna let you know. Set a car on fire, right? I saw the funniest Babylon Bee, the satire fucking magazine. Dude, they had the funniest cover. It was like a war veteran shames Trump for cutting off his Social Security, and it was a picture of a Civil War vet who's like fucking who's been cashing Social Security. They've been using his name because you guys know there's been some Social Security fraud, and there's dead people collecting Social Security checks and whatnot. And that was just one of the funniest things I've seen this week. Bring back satire. All right, so we're gonna go to press conference about 5 minutes. Perfect time to go get some water. Everybody, go get a coffee. Go get some water. We got a cool 30-minute press conference here. Jerome Powell. We got the drinking game. I'm gonna be taking sips of coffee. I'm probably gonna have an aneurysm. I'm gonna have fucking what is it called? Uh, Whatever. When you have a fucking high heart hypertension, I'm gonna get that by the time this drinking game is done, because I'm gonna be drinking coffee shots based on our bingo cards right here. Let's see how this goes. Press conference, 5 minutes, everybody. We'll see you guys back here in five. I'm not sure if the sound is coming through. I think they kind of block the sound until interesting. Okay. Well, the music's not coming through, but it will as soon as the meeting starts. So see you guys back here in a couple minutes. All right, audio check.
Can hear you, Roy, but can't hear him.
Colleagues and I
Oh, no, we can. We're good.
on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Oh, QB Stew is
The
in there.
economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid and inflation has moved close to our goals. Today, the Federal Open Market Committee decided to leave our policy interest rate made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated.
He just said that they're basically not cutting rates for a while.
Estimates based on
That's going to come up in the Q&A portion for sure. He just said in the next 2 years.
5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures.
I'm going to skip out on the shorts here. Everything is going exactly as expected. So there's a chance for this breakout. I'm not going to take the shorts, but if it does come all the way back down, I am still waiting for those longs at the bottom of the range.
Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
There it is. Take a shot,
Today's
people.
meeting, the committee decided to maintain the target range
Dual
for the
mandate.
federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario.
This is like the bet of each Fed official, and they just kind of put all of the bets into a dot plot, and they're all kind of expecting anywhere between 3 to 4.3 So it seems most of them are on the low side. They're expecting the interest rates to go down over time
of next year.
on the lower side of 4, not on the higher side.
While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion.
Sheesh.
Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices.
There it is
We remain
again.
committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions.
By the way, that should have been an easy one. I should have said Fed's target of 2%. That should have been a gimme. But so far, so good, exactly as expected. He did say a few interesting things that I am keeping to the side here, but in terms of, okay, here's the fun part. Let's go.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs, and since
There it is.
policy path remains the same,
The first question, people. Take a shot.
are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year.
We got a nice rejection there if anybody wanted to scalp those shorts, but I'm personally not in that trade, just a heads up.
Very, very challenging. So some of it, the answer is clearly some of it, a good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well,
look, as a nerd for this stuff, I'm gonna give you guys some real insight on this as soon as we're done.
And inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. we're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
What the hell did he just say?
Thank you. Colby Smith with the New York Times. You just described inflation
Go, Colby.
expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros of the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is.
Yeah, I think the shorts are done here. So if you guys have scalped those, I think everything is basically exactly what we expected from Jerome Powell.
We have that price stability. Households and businesses are ignoring price growth. When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress. GDP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
They look at the, they wrote down, meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly in.
Translation, if you have a job, you're not really at risk of losing it. There's not that many layoffs unless you work for the government. But if you're trying to find a job, not the hottest market. Same story we've been telling for about 3 months now.
Situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect?
It's only been 6 weeks, bud.
In the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area. But at the national level, they're not significant yet. But we don't know. We don't know how far that will go. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it will come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. That those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes. During
Okay,
the
'cause you
pandemic.
could have been talking about the last time there were tariffs,
Okay.
in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, you know, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, you know, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. You know, we haven't had real price stability fully reestablished yet, and we have to keep that in mind. And you know, we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, you know, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging, you know, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them. And we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels. You know, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed?
The Fed is not independent. It's under the Fed. It's under the executive branch.
Jerome some time ago, and I have no desire to change that answer, and I have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless, we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of it. We're well aware of how things are going to evolve and the timeframes and all that. And, you know, we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now,
we will use our tools to foster our goals to the best we can.
The soft.
Tell me that's not the most media trained answer.
And we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about their.
Economics is always uncertain, people. It doesn't matter who the president is. Economics is always uncertain. And so they're having to adapt and adjust, but they're thinking long-term regardless. And I think Jerome Powell is actually having a pretty good, you know what I'm saying? He understands the difference.
At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that, you know, you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that. And the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was.
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. You know, the idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string.
So back in the day, people would analyze every single movement of the Fed meetings, including the choice of attire. And so purple, right in the middle of red and blue, right? Not taking sides, being neutral. It's not a blue tie, not a red tie. Red tie is typically serious events. Blue tie, you know they're going to be lower in interest rates. Purple tie, very rare. Purple tie and calm Jerome. He said, this is not my fight. We're going to stay over here. We're going to let the executive branch stay over there. Let Trump, you know, do whatever executive, I would say, like, you know, international economic policies that he wants, and then we're just going to adapt accordingly with no fuss, with no problems. I think it's a really neutral tone. I think this is about as bullish as it gets.
Make a lot of progress on that, and we already have, but it's going to be a challenge.
Do you have a sense yet as to what in your mind would make something cross from noise to a signal, what that threshold would look like?
You know, it would depend on what we're talking about. I mean, obviously you're looking for direct evidence that.
Also, if you guys have been doing the coffee drinking game, you probably have heart palpitations at this point. So just go ahead and cool off on the coffee. We've hit tariffs. We've hit the dual mandates twice. We've hit inflation. We've hit political influence. Everything except for the Atlanta Fed question. That's probably why I'm still on here. I know that question is going to come up. It might be like a niche thing at the end, but let's see if we can hit all five.
Moving down in a very good way. It's more now with goods and to some extent with.
And needless to say, in terms of the NASDAQ trades, number one, I'm glad I didn't take the shorts. That was a intuitive decision just based on how everything was going according to plan, which is typically bullish for Fed meetings. And so that's why I decided to stay out of the shorts. This thing is probably going to do a rejection at that zone I marked off, but will very likely continue through and probably finish off bullish.
The hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think
she's cooking.
I mean, remember we came into this with at the December meeting, the median was 2 cuts. The median was. And so you come in and you see, broadly speaking, weaker growth, but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that. And we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems.
Let's reiterate that sentiment has fallen off. So people are like, oh, things have to be going bad because of Trump. But the actual economic activity has not dropped off at all. And so which one do you guys think has a more material impact on the economy, like the actual production of the economy or the sentiment of these surveys that they're doing? I would say the actual production.
At the price level.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast. And I was just wondering what.
That's tariffs again. I'm definitely going to have a heart attack at this point.
Already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have.
The fear of tariffs, because none of them have been actually implemented. So there hasn't been any material difference because of the tariffs.
I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet. So yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's gonna be slower for longer. And people really like that. People thought that's a good idea. You know, it's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire. Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question of asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change. And in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5 year and out, and there's really no story to tell 5 years and out, either in market based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Yeah.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth? And do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff though, because, you know, we want to stop runoff in net at some point. We haven't made any decisions about that. But, you know, we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. You know, I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, you know, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today, you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, you know, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. You know, sometimes with language, it lives its useful life, and then we take it off, and that was the case. So there's really not meant to be any signal here. Over the past year, you know, conveying this sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember. But we're past that. Oh, sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. You know, the real economy, the hard data are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, you know, we don't want to get ahead of that. You know, we want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly. And of course, we'll understand that, but you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well,
what a 2024 question.
Situation where we have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running.
Well, this is where Jerome Powell he needs to talk his shit and say he actually did do the soft landing scenario where he did bring inflation down without crashing the economy. And so just all he has to do is be like, look at my track record, just look at the stats.
Which would send
The past 2 years, I think, kind of demonstrate Jerome Powell. I'd give him a B plus. I give him a B plus, A minus. Not the worst Fed chairman of our lifetime,
spending
Also not a very high bar to beat.
outlook for inflation.
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
A consummate professional.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up.
That's the fourth time that tariffs have been mentioned. Let's go ahead and stop the bingo game at this point.
We've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecast.
Really, the only tariff war that we need to be concerned with is China. Like Mexico, Canada, Europe, they're all going to play ball. China, we got a pretty tough, we got an uphill battle here.
I had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yo, somebody find out what news station was she from? That was a legitimate question. That was a real human there. Somebody figure out who that was.
Pausing for a variety of reasons. And so people really came to be, pretty strongly in favor of this move, slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows that got us thinking about this.
The follow-up
the more we
too?
thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again. And that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month. And we think it was a good play. And as I mentioned, well supported. Thanks very much.
Whoa. Okay, so the most contentious thing for the Fed, like the one thing they'd never want to talk about is their relationship with the US Treasury, because it kind of got exposed during COVID, kind of how blatant quantitative easing is money printing, where basically the government invents bonds out of thin air, and then the Fed creates money out of thin air, and they just trade with each other. And so you're just trading two imaginary goods, but when you trade them, they become real. Because if the Fed gives you money, that money is now real because the Fed said so. And if the Treasury gives you bonds, then those bonds are real, even if they just created them out of thin air. So kind of all this talk about the relationship between the TGA, which is the Treasury General Account, the piggy bank of the US, and the Fed's operations of either putting money in or taking money out, kind of had them on skates. That was pretty interesting last question. I'll go through and look at that one in more detail. But basically, if you guys were playing along with the Fed press conference bingo game, the drinking game, whether it was coffee, tea, whatever it was, you should go see a doctor. Okay. We hit on every single one of these points. Obviously, there was the generic baseline, data dependent, we'll have to see. Then there was the dual Fed mandate, price and price stability and maximum employment, obviously. And there was about 4, maybe 5 questions about tariffs, the impact. I think the last one was very, I think that one was the most legitimate, which is what is the effect of retaliatory tariffs? But like I said, kind of I interjected there, is most of the countries that we're having tariff wars with, these are, I think I heard somebody say this, Tom Ellsworth said this. He said, these are tactics, not taxes. All right, so tariffs under the Trump administration, these are not, we're not trying to tax these other countries like people think that tariffs are supposed to be. These are just tactics in order to get them to bend, because these tariffs would crush their economy, and they're going to do the thing that, we've been needing them to do the whole time, like secure their border or whatever it might be. So long story short, retaliatory tariffs from China, I think, are the ones that are going to have the biggest effect, because even Trump, I think, subtly has admitted that if we go into a trade war with China and we're trying to bring manufacturing back to the United States, there's going to be a short term, like ripping off the Band-Aid period. When you rip off that Band-Aid, that when you do it in that 30 seconds, 2 minutes, whatever the hell it is after, not fun. And then you got to disinfect the wound, and that's not fun either. And so we're kind of getting into a place where, like, if we're going to go into this transition period of bringing back productivity to the US and onshoring manufacturing and making the US much more productive, self-reliant, and less dependent on China, there's going to be this like little period of time where we're going to have to go through some hurt. And so I think that's a main factor. I think that the Fed is expecting these rate cuts because even though their projections, and the only thing that the Wall Street and the Fed have kind of like they agree on right now is that there's going to be inflation this year and the next 2 years. Because if you're going to start beefing with the people who are, supplying you with the stuff, and stuff gets more expensive, inflation's going to come. And with the interest rates where they are, with kind of a lot of people looking to move their money to the US because of the productivity growth, a lot of outside money, there's going to be more demand chasing fewer goods. That's going to cause inflation. And the Fed is basically preparing us for that. All right. So if you're a household, understand that, things may be more expensive than you expect in the next couple of years, but it's for the greater good, because we don't want to have a country for 2 years. We want to have a country for until as long as we live here. And so let's rip off the Band-Aid now instead of having to amputate the arm later, because we didn't want to do the thing. And I think that we should expect higher interest rates for longer. And this is the funny part that I told you guys I was going to mention at the end, which is Jerome Powell's entire legacy is predicated on that phrase, transitory, because when we were dealing with inflation at 5 or 6%, and then Biden was going to dump that giant omnibus bill, the Inflation Reduction Act, which basically made inflation jump to 9%. Jerome Powell was like, every month that they would ask him, every press conference, he would just say that inflation is transitory, this is going to come and this is going to go. And And then it just kept changing. And then what transitory meant, it just kept changing. And then it was kind of like a stain on his legacy because it was either the Fed was naive or whatever it was. But now he actually did orchestrate a soft landing. He did bring down inflation. Let's go, Jerome Powell. And then the economy did not crash. So something went right. They're reducing their balance sheet. So things are headed in the right direction. And I think higher interest rates right now are for the best. But if you're trying to buy a house, get a car, anything like that, next couple of years, it's going to be a little bit of the same. They might drop a point or two, but hey, the rent prices will probably go up because if people aren't buying homes, they're going to be renting. We're going to see a lot of that going on. So those are just a few trends to watch out for. Higher interest rates for longer. Oh, so the funny part is now he's saying that tariff inflation is transitory, which, if I'm going to be completely honest, I actually agree with. And so he went from basically like his entire brand, his entire legacy was around this whole inflation being transitory thing. They tried to clown him. He orchestrated a soft landing. Well done. And then now he's actually gone back to the transitory thing, except he's right this time. All this tariff shit is like, these are not taxes on other countries. Trump is using them as a tactic to try to get what we want. And I think the productivity and onshoring manufacturing is going to have a way bigger impact than whatever fucking Luxembourg or Canada are going to try to do. So yeah. Oh, what's up, Jason? I was just about to wrap up. Fed meeting done.
Oh no, you're good, bro. I'm just getting these dogs worked on.
Are you being for real? Are you getting a pedicure? Is this what's happening?
Yeah, you got to take care of what takes care of you.
See, this is what happens, bro. Every time that price goes above $2.10, this man's getting a manicure or something. I said this is exactly why. I had to check the price first. This is crazy.
Yeah, man, I was taking shots on the bingo card, so
Brother, call a doctor. Also, there's that sell from earlier. Now that the Fed meeting is done, they're going to wipe out all the retail traders who are holding these longs, thinking they're about to take it to the moon. You guys know the moon, right? Everyone's, oh, to the moon, right? They're bidding it up. They're bidding it up. And so this price level right here was, if we had closed above that price level, then we're going to continue and kind of blow through. There's still about half an hour left in this hourly candle, but if we close back under this 1 hour support, then we're headed down to that buy entry. If you guys were playing along with the bingo game, just forget your score. Okay, I won. If you were drinking coffee, call a doctor. If you were drinking alcohol, call the AA. Okay. Trailing a small short down, it was perfect. 886. Chris, that's because you got your head on straight and you were paying attention. All right. Batman ears. All right. W's take you. I'm gonna leave you guys on YouTube with something to take home. W's take you up. M's take you down. Okay, you're welcome. Go ahead and play around with that. If you care about your financial future, make sure to check out the free webinar NASDAQ Master Class, links in the description. And it's in the live chat. All right, go ahead and check us out. See you guys tomorrow morning on the live stream. Be live trading, maybe. And if you're lucky, you guys might see me on there. All right. Happy and safe trading, everybody. Take it easy. Peace.